The Roth conversion is one of the best strategies to protect your wealth from the greedy piglet that we call the federal government. Here's how it works. You take money from a traditional or pre-tax IRA or 401k, convert it to a Roth IRA, pay taxes on it today, let it grow tax-free, and then you never pay taxes on it again for the rest of your life. But there is a catch. If you get the timing wrong, it could backfire and end up costing you more in taxes. So let me walk you through what you need to consider before pulling the trigger on a Roth conversion. And by the way, this strategy isn't just for people nearing retirement. It can actually work really well for people at any stage of life if the numbers make sense. Step 1, estimate how much tax you'll pay today on the Roth conversion. Remember, the goal of a Roth conversion is to take advantage of lower tax rates today in hopes of avoiding paying higher taxes later. So the first thing you need to figure out is, well, what is that tax rate today? Now, you're probably going to need to use a tax calculator to actually calculate your taxable income. This one right here is pretty good. I'll put a link in the description. Now, once you have your expected taxable income for the year, you can then use the current tax brackets to see where you're going to fall. This now gives you a frame of reference for figuring out how much we may want to consider converting. A good starting point for this is to fill up the remainder of the current tax bracket you're in. For example, let's say you're married and you and your spouse have joint taxable income of $300,000. So you're in the 24% tax bracket. You have $83,900 left of income that you can earn before the next dollar gets taxed at 32%, meaning you could convert $83,900 and have that taxed entirely at 24%. Anything over that would get taxed at 32%. So that gives us an idea for what we may want to convert, but that's only step 1. There's more to this that is really crucial, and I feel like it's what everybody misses. It's not always as simple as just looking at your tax bracket. A Roth conversion doesn't just bump up your income, it can also disqualify you from credits and deductions and maybe even trigger other taxes. For example, the QBI deduction, that starts to get phased out at $192,000 roughly if you're single, or $384,000 if you're married. And it's completely phased out, meaning you lose the deduction completely if your income is over $242,000 if you're single, $484,000 if you're married. The child tax credit is another one to watch out for. So this credit starts to phase out when modified adjusted gross income is over $200K if you're single, or $400K if you're married. So you need to be careful about evaluating the impact of a Roth conversion disqualifying you from this credit. I recently had a client who wanted to do a Roth conversion, and on the surface seemed like a good idea. When we did the calculation to convert $66,000 of his IRA, his additional tax liability from the conversion after losing a QBI deduction and child tax credit would have resulted in an additional $33,000 in taxes, meaning he was going to pay $33,000 in taxes to convert $66,000. That's a 50% tax rate on that conversion. So that's the number you really need to be looking at. That's your effective tax rate on the Roth conversion. But those two things aren't the only thing that it can impact. You may also be subject to additional taxes like the net investment income tax, which is an additional 3.8% tax on investment income once your modified adjusted gross income exceeds $200K if you're single, or $250K if you're married. A Roth conversion could bump up your income to trigger that surcharge. The additional income may also cause an increase to your Medicare premiums or your healthcare marketplace subsidies, both of which can be substantial. It could also exclude you from education tax credits, student loan interest deduction, certain state tax deductions and credits, or even subject you to the alternative minimum tax. So remember, your federal tax bracket is not the only thing at play here. You may end up paying a higher effective tax rate on the Roth conversion than the rate that you just assume that you're in by looking at the marginal tax bracket. So you really need to do a full tax projection without the Roth conversion and then a full tax projection with the Roth conversion to get your true effective tax rate that you're going to pay on that conversion. For the purposes of this discussion, let's say that the effective tax rate on that conversion ends up being 27%. Now we can move on to step 2, which is to estimate the future tax rate. Now, this is a bit harder because nobody can predict the future, but the crux of it all is, do you think the tax rate that you pay on income in retirement is going to be more or less than your current tax rate, which we just determined in this situation is we're going to use 27%. If you think your tax rate will be greater than 27% in the future when you go to withdraw this money to live on, then it makes sense to pay tax on that IRA today at 27%. If you think taxes are going to be lower than 27% in the future, then it may make sense to wait and not convert today. Now, projecting future tax rates is a lot of speculation, and it's ultimately up to you, but let me give you my take. The United States is $36 trillion in debt. Interest on that national debt is now roughly 14% of total spending. It was $882 billion in 2024, I believe. And that amount is just rapidly increasing every year. Tax rates are at historic lows, even though it may not feel like that. At this trajectory, I have a hard time seeing a world where in 30 years, tax rates are going to be lower than they are today. I could be wrong on that. It's just my opinion, but I do think that opinion is backed up by some convincing data. I want to create as much tax-free wealth as I can while I'm young, while tax rates are low. But again, everyone's situation is different, and ultimately it depends on the amount of your future income, sources of that income, the tax nature of that income, and the timeline for which you're going to utilize that income. So there are a lot of factors to consider with this. But in simple terms, if you think future tax rates will be higher, converting now makes sense. If you think they'll be lower, it may be better to wait. So after considering all of that, let's assume that it still makes sense to convert. The final question is, can you afford the tax payment? You need to be prepared to pay the tax on that conversion out of pocket, meaning you can't pay the tax on that conversion with funds from the IRA, unless you want to pay taxes and potentially penalties on that, because it's going to be considered a distribution. This is actually what stops a lot of people from converting or pushes them to convert less than what they wanted. When conversions make sense, generally what I tell people is pick an amount that you are willing to write a check to the IRS for, and then I'll back into how much you can convert based on that. Ultimately, Roth conversions just end up being more complicated than they seem on the surface, so make sure you're doing your due diligence before executing, or seek out help from a tax professional like myself when trying to do this. All right, that's it. Thanks for watching. See you next time.